I want to say something to you right now that I have not said this directly in any public forum before, and I need you to hear it before I give you a single piece of data or analysis. Silver is about to do something that most investors will look back on and say they saw it coming but did not act on it in time. Not because the information was hidden, not because the signals were ambiguous, because acting on it required doing something before it felt safe. And that gap between when the setup is clear and when it feels safe is exactly where generational wealth is made or missed. I have spent 50 years watching that gap open and close. I have watched people understand everything I am about to tell you and still do nothing with it. I am telling you right now, as directly as I know how, that the setup I see in silver today is the same setup I documented in 1979, before silver ran from $1.50 to $50. Not similar, the same. And I am going to give you the specific number in about 90 seconds that tells you exactly why I'm saying that. Stay with me. Here is the number: 6. 6 consecutive years of global silver deficits. 6 years in a row where the world consumed more silver than it produced. 6 years of drawing down reserves that took decades to build. And I want you to understand what that number means in practical terms, because most people hear it and file it away as interesting without understanding the structural implications. You cannot run a deficit in a commodity with genuine industrial irreplaceability for 6 consecutive years without eventually hitting a wall. The question is never whether the wall exists. The question is when you hit it. And the 3 other conditions I am going to walk you through tell me we are very close to that wall right now. Let me go back to 1982 for a moment, because understanding what happened to me then is the only way to understand why I am so certain about what I am saying now. In 1982, I made the most catastrophic public prediction of my career. I told everyone who would listen that a debt crisis was coming that would reshape the global financial system. I was right about the thesis. I was catastrophically wrong about the timing. I lost clients. I had to borrow money from my father to keep my family financially stable. And sitting alone in an empty office, I made myself a promise. I would never again confuse confidence in a thesis with certainty about timing. What I would do instead is identify the specific conditions that have historically preceded major moves, not the conditions that might produce a move. The conditions that have always produced a move. And then I would position when those conditions were present, every time, without exception, regardless of what the consensus said. The conditions I identified for silver have preceded every major silver bull market in the last 50 years, and they are all present simultaneously right now. Here are the 4 conditions. Every single one of them is in place today. Condition 1 is the 6-year supply deficit I just described. Condition 2 is the COMEX paper to physical divergence. Right now there are approximately 8 paper ounces of silver for every 1 physical ounce available for delivery. That leverage ratio has appeared before every major silver short squeeze in documented history. When the paper promise exceeds the physical reality by that margin, the resolution is always the same direction. The paper price gets dragged up to meet the physical reality, not gradually, suddenly. Condition 3 is the industrial demand acceleration that has no historical precedent. The solar industry alone now consumes roughly 20% of annual global silver supply. 1 in every 5 ounces mined on this entire planet goes into solar panels. Electric vehicles use double the silver of the gasoline-powered cars they are replacing. AI data centers require silver in quantities that were not modeled even 5 years ago, because nobody predicted AI scaling at this speed. And condition 4 is the monetary catalyst, the specific policy environment that converts a smoldering supply and demand imbalance into an explosive price move. That catalyst is the same financial repression dynamic I have been describing publicly for months. When governments debase paper currency, the assets with genuine physical scarcity reprice, and silver, carrying both its monetary premium and its irreplaceable industrial utility, reprices with a leverage to gold that is historically averaged between 2 and 3 to 1 on the upside. Now I want you to hold a question in your mind for the next 60 seconds. Are you the kind of investor who looks at 4 converging conditions with a documented historical track record and acts on them before the mainstream catches up? Or are you the kind of investor who reads about what happened 6 months later and remembers that you knew it was coming? Because I have watched that second response destroy more wealth over my career than any market crash. Not the crash itself, the failure to act when the setup was clear. Stay with me, because the most important part of this video is coming. Let me tell you what makes this silver setup categorically different from both 1979 and 2011. And this is the part that my dinner companion could not stop talking about. The industrial demand in those 2 previous episodes was a fraction of what it is today. In 1979, there was no solar industry consuming silver at scale. In 2011, the electric vehicle revolution was theoretical, not structural. Today, the solar industry is consuming 20% of annual mine supply and growing. EV production is growing. AI infrastructure is growing. And the supply response to this demand is structurally constrained in a way that has no modern precedent. You cannot build a new silver mine in 18 months. Permitting alone takes years. Capital investment takes more. The supply response always lags the demand signal by 3 to 5 years in the mining industry, which means the deficit that has been running for 6 years is not going to be closed by new supply anytime soon. And the demand drivers are accelerating, not slowing. Here is the gold to silver ratio right now, and I want you to understand why this single number is the clearest signal in the precious metals complex today. The ratio currently sits near one of its most extreme levels in the last 40 years. In plain language, silver is historically cheap relative to gold right now. Every single time in documented history, when this ratio has been this stretched, silver has subsequently outperformed gold by a factor of 2 to 3 to 1 over the following 12 to 18 months. Every time. Not most times. Every time. The ratio does not tell you the exact date the move begins. It tells you the probability distribution has shifted dramatically in your favor. And right now, that probability distribution is as favorable for silver as it has been at any point since 2011, when silver subsequently ran from $18 to $49 in 11 months. Now let me be completely honest with you about something, because I believe in speaking plainly even when the plain truth is uncomfortable. Silver is genuinely, brutally keep you up at night volatile. It can drop 15% in a single session for reasons that seem completely random. It crashed hard after both the 1979 run and the 2011 run. The same forces that drove it up drove it back down when sentiment reversed. If you cannot psychologically survive a 20% drawdown without panic selling at the worst possible moment, then silver should not represent a large portion of your portfolio. I am not describing an asset you bet everything on. I am describing an asset you understand deeply, size properly relative to your total financial picture, and hold with a written plan that you made when you were calm and rational. The 4 conditions I described tell me the probability of a significant move is very high. They do not tell me the path will be smooth. It will not be smooth. It never is.